All right, everybody, welcome back to Matt Money. Today we have the opportunity to talk about some of the nationwide ETFs, and I have on the screen here my buddy GW. If you guys haven't subscribed to his channel, please go ahead and go do that. One of the best channels on YouTube as far as I'm concerned, and he actually covered a lot of these in detail, in much more detail than I will probably cover them in his video that I kind of have playing up on the screen. He put out this out about 5 months ago around the Christmas time, so what I just want to walk through is kind of the relatively recent performance of these nationwide ETFs and how they're performing up against their index counterparts. Now, the thing that's good about these nationwide ETFs is they're basically collared ETFs. And so what that means is they sell a covered call above the money to be able to collect some income, and they use some of that income to buy protective puts. So in the case of, say, a black swan event or something of the like, you're able to kind of protect yourself from the downside. Now, what we haven't really seen all too well is that kind of come into performance and completely negate everything. So it's not meant to negate everything. It's more so to protect something like what happened in, say, February of 2020 when the market took a complete dive, 20-30% over the course of a month. You saw really good performance out of something called NUSI, which is a NASDAQ 100 collared ETF. And more recently, they've come out with the Russell 2000, Dow Jones, and an S&P version of these nationwide collared ETFs. And so I'm going to walk through them briefly and also look at their index counterparts. So we'll start with NUSI here. It's down about 17% year to date, 18% year to date comparatively to the NASDAQ 100. NASDAQ 100, though, keep in mind, was already declining pretty expansively by the time you got into the January timeframe. So it actually peaked back in like November, December of 2021. But this is a pretty good fund. Dave just did some discussions about this in his video. He has some NUSI that he's using to kind of fund his high yield savings account or one of his accounts. But basically, it's basically writing collared options, meaning a covered call and then a protected put. On the NASDAQ 100, it's yielding about 7 to 8% and paying out about monthly. So what's that actually mean when it comes to performance against the NASDAQ 100? So you can see that NASDAQ 100 since January is down about 27%. I'm just using this as against QQQ. And NUSI is down about 20-ish% in the same time period. So over the past 5.5 months, we've seen a really big decline. But what you're kind of seeing is a more smooth version of what's going on in the NASDAQ. So when you're coming down, depending on how quickly you kind of come down for that month and what options they have, it does actually negate some of the losses that you're seeing. But if it's slow and steady, it's going to follow the NASDAQ pretty quickly. But you can also see in the same exact sort of, action in the opposite direction, if it continues to spike up and it goes very quickly, since you have that covered call on the collar of these sort of funds, you're not going to get that explosive growth like you would out of, say, a QQQ. So remember we had that pop up in late March, going into late March. There, things kind of looked like they would potentially turn back to normal. You didn't see that huge pop up. It kind of just leveled off with some volatility, and then when things started to go down again, NUSI kind of followed the NASDAQ. But as you've seen, these large price declines starting in the beginning of the May timeframe, NUSI's remained relatively flat. And Dave kind of covered it a little bit in one of his more recent videos. It might have been today's video, talking about the put that they had written for NUSI was actually in the money. And so when we go through the funds, you'll see that a lot of these are actually doing okay in terms of where they are compared to their index counterparts. So 8%, 7 to 8% yielder. So can't complain with that. It's pretty good in that respect. But I'm more curious about how these NSPI and NTKI and all these other funds that are kind of coming out to replicate the NASDAQ 100 version from nationwide in the S&P, Dow Jones, and Russell 2000. Now, what I've recognized is these don't go after as high of a dividend yield, or maybe they're just kind of delayed a little bit comparatively. But what you're kind of seeing is about a 7% yield. And I saw that very similar for NSPI, NTKI, and as well as the NDJI. So I don't know if this enough time hasn't rolled through as of yet for those to really come up with their own distribution yields. But at the moment, that's what they're claiming as a monthly dividend yield kind of coming through all these particular products thus far. So when you look at the nationwide S&P version of it, you can see that it's also holding up relatively well. Now, this is a like for like because the S&P peaked out on January 3rd and January 4th, if I remember correctly, of 2022. And then since then, they released the notes from the Fed of the December FOMC meeting, and everything just started going to hell. I guess everyone saw the hawkishness coming out of the December meeting, which I think they were believing that everything was going to be more dovish kind of going into 2022. Notes come out for December meeting, and everything goes to hell. Everybody probably remembers that. But you can kind of see the same sort of trend, right? As things begin to get very scary in the January timeframe, the NSPI fund, or the nationwide S&P version of this collared ETF, does kind of level off a little bit. But as you can see, as we slowly start to bleed off through February and March, it doesn't really have the same impact. And as you can see, we don't get as high as, say, the S&P 500 does in the later half of March timeframe. But as you can see, as we continue to bleed off heavy into late April and May, you do see this leveling off. And I think that a lot has to do with the option that they picked up likely in the late April timeframe. So what I did see, I haven't gone through, say, all these ETFs to see where they're holding their collars, but the NASDAQ 100 is holding their collar at about 11,800 comparatively to 11,325 compared to like the 11,800 or so. So if we do continue to dive down pretty substantially, another 5-10% in this month up until June timeframe, then it will be able to kind of hold and offset any more losses. So below 35%, on the NASDAQ, it'll be able to hold. And I'm curious. I should go back and look at what the collar is going for this nationwide ETF. And I'm actually kind of curious. Let's just do a quick check while I have it. All right. Sorry, I got a new laptop, so let's look for SPX. I anticipate is where it would be. Yeah, so the SPX. So they're picking up a 39.50 call and a 37.15. So that's pretty close, man, for a June. So you're looking pretty close. I think that this thing, if it continues to kind of go down where we're at, they probably spent a good pretty penny on that. I think that if we go down another 2-3%, we'll probably be in the money for this bad boy. So they're really trying to protect on the downside, but keep in mind, if we do kind of return, they also sold a really close to the money call option to be able to pay for that 39.50. So there's not a lot of spread between those two, to be very frank, but really curious to see that. That's or peculiar to see that. That's kind of cool. So I wouldn't expect, if we continue to see huge down days, I wouldn't expect this NSPI to really dive much deeper. So moving on to the Dow Jones version of it, same thing, 7%-ish yield. Let's just kind of pop up and see what this one is holding for the Dow Jones collar. They're doing 280 and 320. So I'm curious. I don't even know particularly where we're at. So they got a really wide collar on this bad boy, because I think pretty certain that they're doing the DJX. Now I'm just kind of curious. DJX index. It's at 312. Yeah, I thought it was just a divide by 100 there. So that's pretty peculiar, man. That's a long ways down for the put side on this thing. So if we continue to see a lot of downside on the NASDAQ, I don't know how well this thing's going to perform for the NDJI, because it's pretty far away from that 280 put, but it's got the 320 call. So I think they're expecting maybe more downside on the Dow Jones. We'll kind of see. Or maybe they expect more upside, rather, because the put side is so far away. But anyway, I guess it also depends on when they wrote this. But you can see that this has held up relatively well as well. Only about 11.5%, 12% down comparatively to the 15% on the Dow Jones. But you haven't seen as much swinging on the Dow Jones as you have, say, for the S&P, or as you've seen for, say, the NASDAQ 100. This is only 15% year to date down, which is actually pretty good. Pretty surprised. But that's probably because you have the Apples of the world and some of these other great companies that have yet to really take a spike to the downside. So I'm really curious and peculiar to see. I think maybe they're just... Anyway, I thought that was... Yeah, I'm just kind of running through in my head the collar strategy that they're using there, and it just seems really far down comparatively to where I probably would have put it if I want to kind of continue to hold that sort of price. Russell 2000 version, same 7% yield, so nothing really changing as of yet there. Let's pull up where they have this this downside here for the Russell 2000. I'm assuming they're going to use the RUT. So let's go all the way down to the R's. Yeah, they're using the RUT. So you have the 1700 and 1810. So let's check out the RUT index, Russell 2000. So what did we say? It was 1700 what? 1810 and 1700. Okay. So the same for this one. They're selling pretty close to at the money, but this one has held up extremely well compared to where the Russell 2000 itself has. It's actually half the amount. And I think maybe it's just because of the huge drops, right? And has been able to kind of level off compared to these large drops. So they've done relatively well with the Russell 2000 comparatively, only down 10% compared to the 22% we've seen year to date on the RUT. So some of these have done relatively well, man. And a 7% yield, I'd say the one that has performed the worst is probably comparatively to its index, either NUSI or the Dow Jones version. But I'm pretty surprised. I'm curious to see how they continue to hold up, though, if we continue to go down another 5-10% from here. I wouldn't be surprised if we see the Russell 2000 go down to 30% off from all-time highs. I wouldn't be surprised if we see the NASDAQ do the same, getting to 35 or so percent off compared to where it's at. S&P, I think we could easily go down 25 to 30% there. So we're down, already 20-ish% on the S&P. So I see another 5% down pretty easily for that. But really interesting. I'm not surprised by the S&P and the NDX collared options that they have from Nationwide. What I am surprised about is the Dow Jones and the Russell 2000. And maybe I'll have a conversation with Davey and Jerry about this and kind of see what they're thinking. I'm by no means the options expert. I kind of relayed that to them. They're pretty damn good at what they do from an options perspective, and maybe I'll pass it by Thumper as well. But really peculiar to kind of look at those, and really my first time looking at them as well. So I was just kind of wanted to share that with you guys. By no means am I advocating for these funds. I've had NUSI in the past, and I've actually moved it more towards an XYLD and JEPI kind of version, and also XYLG, which I don't know if you guys know about XYLG, but it's basically the growth version of XYLD. It's kind of like a midway point. If you were to kind of compare, say, XYLD, sorry, I'm kind of going off the cuff here, but if you were to compare like XYLD and just like the S&P 500, let's just say, let's look more so over the past like year or so, but you can kind of see that XYLD, XYLG, they're kind of underperforming the SPY, of course, but they have a higher dividend yield. And the XYLG, for me, was more about just making only, kind of in between the two, right? I'm not necessarily needing all those dividends, and at the same time, I would like to still get some dividends out of the fund. So I was all about XYLG to be able to kind of give myself a little bit of cash. See this large drop here? That was a huge dividend that we got in December time frame. So that was really cool. It was like a huge dividend that we got. It was like a couple $100 more than I was expecting, and it was really cool. So that obviously doesn't show up here when you can kind of compare like for like, but in terms of like the graph, right? Because it's not going to show the total returns here. So But yeah, I'm looking for kind of that in between, right? Get some of the dividends and also get some of the growth, which is what XYLG is for personally. But maybe when I get super uber rich, I'll just go straight SPY and I'll just use that 1.2 to 2% dividend, depending on what it's got that day. But anyway, enough rambling. Figured out to share this with you guys. Curious about what your thoughts are. I'll probably put this up as soon as possible. But love you guys. Very curious to see what other ETFs you guys might be thinking about as of late. And yeah, just let me know what you guys think. I'll see you guys in the next video. Cheers.